Hey, what's up everybody? Monday, March 15th. I got my COVID shot today. Got the COVID shot. And I get my second shot in a few weeks. Hey, it's Monday. Sent out the new edition of MMT Trader. You gotta get this one. Because I talk about a big move. A big move is coming. If you haven't, been able to capitalize on some of these other big moves, there's another one. I always tell people, don't ever chase after anything. Markets will always present you with opportunities. Okay? You just got to be patient. You got to get in, when the getting is good. And something's coming up. And I'm sorry, I can't spill the beans right here. You got to go to my website, pitbulleconomics.com, sign up for a 30-day free trial. Take it for free for 30 days. You can cancel it, but you got to find out about this move. Now, on another subject, I'm starting to think, how I was talking about leverage ratio 2 years ago. If you go back and you watch my videos, or if you've been following me for any length of time, I was the one explaining about supplemental leverage ratio, about bank reserves, about how banks have to make adjustments when reserves build up on their balance sheets. Nobody was talking about that at the time. And that was a really, back in 2019, that was a really tradable pattern almost on a monthly basis because, we knew what the flows were going to be based on government spending, based on what the Fed was doing in terms of its asset purchases, etc. So we knew when those reserve dumps were going to happen and we shorted the market, and then we knew when the reserve drain came along and we bought. And then last year when they suspended or did that exclusion of reserves from the leverage ratio calculation, a lot of that pattern went away. And since then, just recently, all right, like in the last maybe month, you started to see discussion about this. You started to see a lot of commentary, a lot of so-called, analysis about this phenomenon of reserves, the leverage ratio. But now I think it's getting totally overhyped, and I'll tell you why. I pursue this as science. I don't just make statements or speak in cliches, right? I talked about that. Don't be slick. If I say something, or if I think, there's something going on, I like to see the evidence like a scientist would do. A scientist would test his theories to see if it shows up in the empirical evidence. So here's what I'm talking about. I saw a lot of headlines last week about banks dumping treasuries, And in fact, I was even talking about that a few weeks ago, saying how that was probably a factor in the run-up in bond yields. So I go look, because that data comes out every week. I go look in the most recent data, which, by the way, was in the week ending March 3rd, which saw a 181 billion increase in reserves. That was the biggest reserve increase since last April 2020, all right? Like a year. Banks were net buyers of treasuries. Net buyers of treasuries, net buyers of mortgage-backed securities. Net loan creation. So what does that say? As a scientist, you say, well, there's a theory. The theory is all these reserves being dumped onto bank balance sheets, they're going to sell treasuries, and that was the commentary. That was the reporting that you saw. But in actuality, like the scientist in me, you go test the theory, that was not happening. Who is selling? Again, scientists, got to go check it out. Where's the evidence? Go to the futures market. Who was selling 10-year treasuries? Small speculators. Small speculators are now short 20 billion notional in 10-year notes. 20 billion by small. We're not talking about, dealers. We're not talking about institutional asset managers. We're not even talking about managed money like hedge funds or futures funds. We're talking about small speculators are short 20 billion notional of treasuries. To me, that says a lot, because you got these two things happening right now. Banks were net buyers of treasuries. All right, we didn't see any panic selling. We even saw more loans being created. So it wasn't like there was a slowdown in lending because, hey, banks got to cut back on the risk assets because of the reserves. No. All coming from speculation. Which to me suggests that while, I can't say with exact precision where the upside in bond yields is going to be, but when I look at the market composition right now, when I look at who's selling and who's buying, it says to me that, this is a speculative move. A lot of people buying into the inflation, hyperinflation, and I'm not saying we're not going to see some inflation with the fiscal, but as I've been saying, as the economy opens up, more output, you see a moderation in prices. We're in a growth environment, a rebound of growth environment. Not necessarily an inflationary, or certainly not a hyperinflationary like this kooky guy, what's his name? The Big Short dude. I even forget his name at this point. I mean, that guy is proving to me he's more lucky than smart. Oh, Michael J. Burry, right? And the guy's a little strange. Like he puts out these cryptic tweets, and then he ended up deleting his whole entire Twitter account. Like the Armageddon is coming. Like, I told you so. Bye. I'm out of here. Delete everything. That's a little bit of a kook, I think. Anyway, that's the update. You got to go get the report. Again, there's a position analysis in there, a market analysis in there based on science, what I've been talking about, with a very, very favorable risk-reward scenario. All right, go to my website, pitbulleconomics.com, sign up for a 30-day free trial. Got my shot! Woo! All right, everybody. See you tomorrow. Bye.